The U.S. economy is on a roll. Coupled with last Friday's strong jobs report, data released Tuesday morning continues to show that the U.S. economy is firing on all cylinders. The latest data on job openings indicate that the labor markets remain strong while we see continued growth in the sector, which accounts for about 85% of overall GDP growth. The Institute for Supply Management's reading on service sector activity in May came in at 58.6, up almost 2 points from April and better than forecast by economists. Most notably, comments from the ISM report indicate that with economic activity expanding, many suppliers cannot keep up with demand. Market Economics also released its own look at U.S. service sector activity, and it showed that by its measure, growth in the sector accelerated at the fastest pace since 2015. Additionally, the latest data from the Bureau of Labor Statistics on job openings and labor turnover showed that a record 6.7 million jobs were open in April. This report also showed that the ratio of unemployed workers to open jobs now stands at 0.95, indicating that there is more than one open job for each person out of work. Kathy Barrera, who's the chief economist at ZipRecruiter, noted Tuesday that April marks just the second time since 2000 that there were fewer unemployed workers than jobs open. So, with all this great news, what is the smart money doing? Let's take a look. Before we get to the smart money, I want to remind you that the periods of low volatility and market calm are the seeds for high volatility and market chaos in the future. And then, of course, it reverses. And out of the last 10 years, roughly 85 to 90% of the time was peace and quiet. But the other 10 to 15% of the time were wild spurts of sharp chaos and wild turbulence. So what can we make out of that? Don't confuse the current calming market as a signal that everything is going to be okay. Unfortunately, that's what the crowd is doing. And things have gotten so peaceful that according to Goldman Sachs, Wall Street is near record quiet levels once again. And looking at this chart here, you can see that the volatility, or the VIX, with regard to the S&P 500, it is down 21% on a 3-month basis. All right, so what's happening? The market and traders, investors, are becoming overly complacent. So the lesson? Watch out. This chart here is the Smart Money Flow Index. So let me explain. The main idea is that the majority of traders, investors, are driven by news and emotion, and they overreact at the beginning of the trading day because of the overnight news and economic data. So there's a lot of buying on market orders and short covering at the opening of the market. And the so-called smart money is the experienced investors who start trading closer to the end of the day, having the opportunity to evaluate the market performance during the day. And one of the strategies is that you bet against the morning price trend and bet with the evening price trend. So looking at this chart here, you can see that we haven't seen the SMFI, as it's called, drop this much since the Great Recession of 2008, and then of course the dot-com bubble of 2001. And here in this chart, the smart money flow is indicated in red, where the Dow Jones is indicated in blue. And as you can see at the far right of this chart, the smart money is fleeing the market. Let's keep this in mind. And so I can hear it in my head right now. Marco is asking the question, well, if the smart money is leaving the market, how come the markets are heading higher? Well, I have part of that answer for you here. As of the first quarter, share buybacks, corporate share buybacks, reached the highest level on record. And that's excluding energy, metals, and utilities, but certainly in the high-tech sector. Again, corporate buybacks are at record levels. That's what's helping keep the market up. And nobody ever accused corporations being smart money. So for today, that's ChewDog Charts. Thank you.